You've probably heard this rumor floating around, right? The idea that the government is somehow taxing you for withdrawing your own cash from your own bank account. It sounds pretty wild, maybe even a little unfair. Well, today, we're going to pull back the curtain and figure out what's really going on with that rule.
So let's just cut to the chase. Is the government actually hitting you with a tax for taking out your own money? The simple answer is no. But, the full story is a little more complicated than that, and that's exactly what we're going to unpack right now. Now, this whole scare isn't just something somebody made up. It comes from a real law, Section 194N of the Income Tax Act. But honestly, it's probably one of the most misunderstood rules on the books. So let's break down exactly how it works and, more importantly, what it actually means for you. Okay, here it is. This is the most important thing to get your head around. Whatever money gets deducted, it is not a new tax. It's something called TDS, which stands for tax deducted at source. And understanding this one simple point, well, it changes the entire conversation. So if it's not an extra tax, then what in the world is it? Well, think of TDS less like a penalty and more like a mechanism. It's basically the government collecting in advance on your taxes. And the best part? It's not lost money. You can absolutely get it back. So what TDS really is the government collecting a tiny piece of your potential tax bill ahead of time. It's a way for them to keep an eye on really big cash transactions. When you go to file your annual tax return, your ITR, that amount is just credited right back to you. The process to get it back is actually super straightforward. Let's say your bank deducts some TDS. That money isn't just gone forever. When you file your taxes, maybe you owe the government, say, 50,000 rupees. But if they already collected 10,000 as TDS, well, you only have to pay the other 40,000. And what if you don't owe any tax at all? You get the full 10,000 back as a refund. It's as simple as that.
Okay, so here's where it gets interesting. This rule doesn't hit everyone the same way. The limits, the rates, all of it really depends on one huge factor: whether or not you file your income tax return, your ITR. And believe me, the picture is very, very different for each group.
This table really lays it all out nice and clear. If you're someone who files your ITR regularly, you get a really generous limit. You can pull out up to 1 crore rupees in a financial year with 0 TDS. It's only for the money you withdraw above that 1 crore mark that a small 2% TDS kicks in. But for someone who hasn't filed their returns for the last 3 years, the rules get way stricter. That tax-free limit plummets to just 20 lakh rupees. Go over that, and you're looking at 2% TDS, and if you cross 1 crore, it jumps to a pretty hefty 5%.
And here's another really key detail you can't miss. These limits, they're not per withdrawal. They're not per month. The bank is looking at the grand total of all your cash withdrawals across the entire financial year, all the way from April 1st to March 31st. Every single cash withdrawal, big or small, gets added to that running total.
Let's make this real with an example. So imagine you're an ITR filer, and over the year, you withdraw a total of 1.2 crore rupees. That first 1 crore, totally TDS-free. The TDS is only calculated on that extra 20 lakh. So at a rate of 2%, that's $40,000 in TDS. And remember, that's $40,000 you can claim right back when you file your taxes.
All right, now for a big word of warning. If, for some reason, your bank account is not linked to your PAN card, your permanent account number, things get very serious very fast. For any cash withdrawals over 20 lakhs, the TDS rate skyrockets to a massive 20%. That's a huge signal from the government that they want every account properly documented. So where exactly does this rule apply? Well, the short answer is pretty much everywhere you'd keep money. All banks, whether they're private or public, have to do this. Same goes for cooperative banks and even post offices. It covers your savings accounts, your current accounts, and it doesn't matter if you're a resident of India or an NRI. It applies across the board. At this point, you're probably asking, why? Why go through all this trouble? Why did the government even create this rule? And that's a fair question. It's not just about collecting a bit of tax in advance. There are some much bigger economic goals at play here. Really, it all boils down to 3 main objectives. First, the government wants to discourage people from making huge transactions in cash. Second, and this goes hand in hand, they want to promote digital payments, which are much easier to track. And third, this whole system creates a clear paper trail for large sums of cash, which helps in the larger fight to curb black money.
Whew, okay, we've covered a lot of ground, so let's just take a moment and boil all of this down to the most important points, the things you really need to remember so you can manage your money without any nasty surprises.
So, what does all this mean for you personally? First, and most importantly, remember this is a refundable TDS. It is not a tax that you lose forever. Second, your personal limit all comes down to whether you file your taxes or not. So, the big takeaway here is pretty simple. For large payments, try to use digital methods. And maybe the most important thing of all, file your ITR on time every time. It's really the easiest way to make sure you're getting the best deal under this rule. And there you have it, the whole mystery behind Section 194N all laid out. It's not some scary new tax, but a system designed to encourage more transparency in our economy. Which really just leaves one final question for you. Now that you know how it all works, are you going to manage your cash any differently? That's all for this explainer.